Hello and welcome back. Today we're going to look at the concept called efficient frontier and capital allocation line, and we're going to look at examples taken from Sweden, both on funds and stocks, and also some theoretical efficient frontiers. So today's agenda is that we're going to look a little bit at the risk-return profile of Sweden, or at least some examples. We're going to look a little bit at international diversification. We're going to look at efficient portfolios and efficient frontier, and we end with looking a little bit on CAL lines, on capital allocation lines. Just some brief notice if you want to do this yourself. All the data here is gathered either from Yahoo Finance when it comes to the assets, or from Morningstar when it comes to the funds. I've taken historical data monthly from 2011 and to 2014. And of course, this is not representative at all. These have been generally quite good years. If I would go a little bit further back, maybe to 2008, it would look much worse. But they are just to give you a picture of how it can look. And then I have a quote from Warren Buffett, which I think is quite good, which says that in the business world, the rear view mirror is always clearer than the windshield. And it means that if I go back in time, I always know which stocks are the ones I should have picked, because I know what will happen. But generally, we don't. We don't know what's going to happen in the future, and therefore, the ones that look good in my chart, they are good only based on their actual performance. It doesn't mean that they will perform well again in the future. Here is just a short list of the companies included, if you want to look at it. These are the global funds that are included. There are 3 of those. And the SEB fund is a mixed fund consisting of both equity and bonds. And we have 2 Swedish stock funds that are included. Okay, this is the risk return of the different stocks that I have looked at. So we see some stocks have performed quite well when it comes to return. This is annual return. And here on the right-hand scale, we measure standard deviation. So the further to the right you go, the more risky they have been, and the higher they go, the better return they have given. So to be far to the left means less risk, and up higher means better return. So you would like to be up here, very high return with no risk. Of course, there is not a single stock there. And then we discussed a stock index in one of the other videos. And I mentioned an index called OMX S30, which is usually seen as a measure of how the Swedish market is doing in general. And here we can see how OMX 30 has done. So it hasn't had such good return as some of the stocks, but on the other hand, we also have quite a few stocks with very low return on the Swedish market, which is why this index is quite low. What is interesting, though, is that it's quite far to the right, if you compare to some of the stocks over here, maybe. Oops. For example, compared to this stock, the OMX 30 is very low in risk. So although these stocks to the very right is included in the index is still on the same level as the least risky stocks, like the one here and here. So when we see this index how the market in general has gone, we should believe that if we have Swedish funds, or funds investing in Swedish stocks, they should be somewhere around here. And that's in fact what we're going to observe as well. So these red dots here, they are Swedish funds. They appear to be very close to these 2 stocks, but they are actually consisting of quite a few stocks. So we have the Swedish funds. As you can see, they are higher. That means more return than the OMX 30 was, which was somewhere around here maybe. And they are also, at least one of them is slightly riskier up there. So that's just an example of 2 Swedish funds. There are probably those who have gone better, those who have gone worse, those who are more risky, and those who are less risky, but at least they are examples. If we also include funds investing in world, in globally, in stocks all around the world, then we see that with almost the same risk level, which is measured here, almost the same return measured on the vertical scale, they are both substantially less risky than the Swedish fund. So this distance here is, of course, partly due to having a slightly low return. You can see that this one is slightly below the most risky Swedish fund, and this one is also slightly below this one. But the main part of this comes from the international diversification. So it appears to be a gain in risk, or rather that you get less risk if you invest globally, so not just in a Swedish stock. The one at the top here, that's the one at the bottom is the AMF Aktiefondvärlden, which is a Swedish fund, quite not so expensive. There are much more expensive funds. It's an index fund. And there above we have the AP7 SOFA fund, which is the pension fund you get if you don't choose. As you can see, these are, they appear to be so that the riskier fund here also has a higher return compared to the other one. And I mentioned this in the video on trading cost and leverage, that the AP7 SOFA is actually a leveraged fund. So it should increase the risk, but it should also increase the return in case there's been at least positive returns. So this one seems to confirm that if you take on leverage, you get a higher risk, but you also get a higher return if things go well, as they did during these 3 years. What is also very interesting is when we look at the other fund, the other global fund we had, which had invested partly in bonds as well, because usually you have a not so strong correlation between bonds and stocks. And as you probably remember from Finance 1, the lower the correlation, the easier it is to get diversification benefits. So here you see that the risk is substantially less for this mixed fund compared to the other ones, although the return is not that much lower. So they have not invested that much in bonds, but it still helped to reduce the risk quite a lot. Again, this is only during this 3-period sample, so probably that's not the case always, that you have this good result. Okay, now we could ask ourselves which one of these are not efficient. If we assume that these are the future profiles, or that we know that they're going to get this return for this risk, which ones would we definitely not choose? Okay, so we usually don't like risk. So if we go further to the left, that's better. And we also like return. So going further to the right, top or up, that's also good. So these are two good directions. Going to the left means less risk, and going up means more return. But that also means, if we just remove this, that if you are below, so for example, you can compare these two to the one down here, this one must be much worse because it has lower return but more or less the same risk. So I would not like that one. And doing like this, we could cross out most of these, in fact. So these two, for example, they are not that good because we have one of the funds above, the World Fund, which has the same risk but higher return. This one here is not good because we have a World Fund, or both of the World Funds with the lowest risk are less risky and higher return. So these two over here trump that one. Same goes for that one, these two, that one, that one. If we go up a little bit, we can say that this one should also go because it has higher risk and less return than the two stocks that give the highest return. And then we have one at the very end here, which is also very bad because it's very risky and the return is not good enough. The other ones, on the other hand, we cannot rule out right now. We might think that some are better than the others, but if we draw a line here from this one's return, we see that there is no one below that return which we haven't already crossed out. If we do the same here, even the ones that are very close in the return, they are slightly higher, so it could be efficient to go into one of these. And we don't know which one is actually the best one right now. But we can at least cross some out. Okay, what we're going to do now is to realize that actually I don't have to invest all my money in a single stock, as in this case, or in a single fund, or in funds at all. I could actually put some of my money in a bank account. Okay, and at least for me as an individual investor with not that much money, putting the money in a bank would be considered for me risk-free. I will not lose that money. I will of course not get as high expected return, but I will at least not lose it. So I can reduce my risk by putting some money in, for example, this fund and some money in the bank account, and that way shift my risk to the lower end but reduce the return in some sense. And how can you then compute and use that to see which ones are less efficient of these? Well, when you have return, it's always a linear function. If you combine any two assets, the return is always a linear function. When you have a risk-free asset, that is also true for the risk. So when you take any different combinations of some part in the risk-free and some part in the asset, you will get a straight line connecting them. So, for example, we could connect the risk-free with this blue line here. Sorry, this blue fund, one of the world funds, and say that we can access any part on this, at least it's supposed to be a straight line. And what does that mean for me? Well, it means that that one is actually not efficient, because by investing some part in the risk-free rate and some part in this fund, I can reach the return level of here, taking the same risk as investing all my money in that fund. Therefore, I would not like to invest in it. In the same way, I can combine this guy up here with the risk-free rate. Let's see if I can draw a straight line. I hardly think so. Okay, yeah, not so straight maybe. But if I could, I would see that also this one is not efficient, these two are not efficient, and this one is not efficient. The only one I cannot rule out is the fund here. So that one could be good, and if we draw a line here to that one, we see that actually, okay, it doesn't cancel out any of the other portfolios. So making a slightly nicer line have here, we see that if I combine the risk-free rate with this one, all below this line will not be efficient, because I can invest in that stock and some money in the bank account or the risk-free rate and get the risk level that I desire. Again, this stock probably don't exist in an expected return scenario, because this is realized return from the last 3 years, and now that I know it, of course I should have put more money in this one than I did in that stock maybe, but I didn't know that 3 years ago. So it's always easy to be wise when you have the facts. Okay, and then we get a picture like this. These are the only two possible candidates for having an efficient portfolio. Okay, where can we go from here? Well, we can take another example using monthly data and construct what you might remember from Finance 1, where I've seen in the lecture, called the efficient frontier, or in this case actually the minimum variance frontier. So these are monthly data on some Swedish stocks, not exactly the same as before, but most of them are. And then I have theoretically used how they have covaried, so how they move together, to construct portfolios with that takes on a quite low variance, actually the minimum variance for given returns. And here are examples of some of these portfolios. So if you look at this picture, it looks as if it's very easy to get a very good result from diversification. So just combine these in the right way and you get a very, very low diversification. But when you compared the Swedish funds earlier with the Swedish stocks, you saw that the funds had actually, okay, they had quite low risk compared to some of the more risky stocks, but it's nothing like this. They were very similar placed to the least risky stocks. And the reason for that is, of course, this I've used data in historical information of how they move together in order to use mathematics to get the best or the minimum variance portfolios given how they moved in the past. But the fact that they moved in a certain way before doesn't mean they're going to Kumo in the same way in the future. So this is a little bit theoretical and cheating to get the perfect frontier. But anyway, this would be what is called as a minimum variance frontier, although it probably should go down a little bit and a bit above as well. Okay, if we usually see this in a textbook, it's going to be something like this, a curved line. This is the same frontier as we had before, just with a solid line this time instead of the individual portfolios. And what you're going to do now is that you want to combine portfolios here with a risk-free rate to find out which ones are efficient here. So not all of these are efficient, but again, this is called the minimum variance frontier. It's good to know what it's called. So that's all of this, not just the upper part as it appears now. Okay, so let's take 3 different portfolios here and see how we can combine them with a risk-free rate and see if that means we can exclude some of the stocks, some of the funds or portfolios. Okay, so now I will again attempt to draw a straight line. And I can begin maybe with this A. Okay, so combining A with the risk-free rate doesn't seem to exclude anything except for this lower part here, because all the portfolios here have more risk and less return than A and are therefore not efficient. If I combine the risk-free rate with B, then I can see that I can actually exclude everything below B as well, including A then. And the reason for that is that even this minimum variance here, this point here, is actually less good than taking B and some part in the risk-free rate. And if I do the same with the portfolio P, see if I can get this to be a straight line, something like this, then we see that everything even below P is actually inferior, because I could always take P, put some money in the risk-free account, and get a higher expected return and for the same risk, or possibly I can get a lower risk for the same return. So let's say I would like this amount of return here. Then if I combine P with the risk-free rate, I get a little bit longer to the left, which means I have a less risky investment. Also, usually when we look at a textbook, these lines are going to continue. So they're not going to stop here, but they're actually going to look something like this. And again, now we get much nicer straight lines than I can draw. These are called capital allocation lines, or CAL. And usually you write it like CAL for A. This is the CAL for B. And this is the CAL for P then. And if you look at the difference from what I draw, I only drew from the risk-free rate to the portfolio itself, whereas these one keep going to the right. And if we do that, we can see that this line using P is better than any other portfolio, because the one that are even more risky than P, well, we can just go further along this line to get a higher return than we could for the same risk level here. Why did I not draw them, and why are they drawn usually? Well, if you do this, investing into P means investing 100% of all your money in P. Going to the left towards the risk-free rate means putting a little bit in the risk-free rate, a little bit more, until we put all our money in the risk-free rate. Then going to the right must mean that we should invest more than 100% in P. That's the same thing as saying that we leverage our investment. So going to the right above or to the right of this portfolio means that we borrow money to invest more in the portfolio itself. So I have as much money as I have, then I go to the bank, ask for some more, and put all of that money into the portfolio P. So when I have a line that keeps going like this, which is called a capital allocation line, then I am borrowing money. And since the line has the same slope here as it does everywhere, it means that I assume that I can borrow at the risk-free rate, something which I'm quite sure the bank will not allow me personally to do, but maybe there's someone who can do that. Okay, then what we can see, if we go back again here, is that which of these lines are best is the one which has the steepest slope. So this one is quite flat, so not so good. This one is slightly steeper, but the best one is the one connected with P, and that was the one going furthest up the steepest slope. It means that for every unit of risk we take, we get more return if we have a steep slope. And what is this slope then? That's something we might want to ask ourselves. So here it should say the expected return of portfolio P. And here then we have the risk of portfolio P. Okay, so how do you compute the slope of a straight line? This is, of course, repetition for all of you, but we do it anyway. So what you can do is you can look at the change in the y-axis, which is the return. And we have the measure here. For the portfolio, we have E of RP. And then here at the very bottom, we have the risk-free rate. So we take the difference between the expected return of the portfolio and the risk-free rate. And then you should divide it by the change in the x-axis. And now we go from 0 to sigma p, so the standard deviation of the portfolio. And then the difference is just the, oops, that was not very, there we go. The difference is just the standard deviation of the portfolio. So the slope is measured like this. And this, you should, or maybe recognize it as the Sharpe ratio. Okay, so actually the slope, we want as steep slope as possible, and the slope is measured as the Sharpe ratio. Okay, so that's one of the reasons why Sharpe ratio is so widely used for funds, because it helps you find out or select which funds are actually the best ones. The higher the Sharpe ratio, the better they are, at least if you assume that you can leverage up your investment. And this is also why in StockTrack we use the Sharpe ratio as one of the rankings of your portfolio. Okay, so remember that when you're working in StockTrack, try to improve your Sharpe ratio. And you can do that either by reducing the denominator, which is the risk, or increasing the numerator, which means getting a higher return. Of course, this should be expected, but in StockTrack they use realized. Okay, what happens then if I cannot borrow at the risk-free rate? So this part here is actually not very realistic. We can assume maybe that we have a different rate that we borrow at, this RFB, which stands then for the borrowing rate. We have it here. Well, it should mean that we should connect the line to the right of P with this new rate. And again, the slope, it was the expected return of the portfolio P minus the value here at the y-axis, which used to be RF, but now we have a different rate that we borrow at. So it's going to be RFP divided by the risk. And since this one here is higher than the risk-free rate, it's going to be not a steep slope. So it will be something like that. Okay, we can look at it in a better picture, which I haven't drawn. And we see that this curve here is what you would call kinked. And the most important aspect of this is when you realize that borrowing rates are usually higher than the rate that you can get yourself if you invest in a risk-free asset. It means that these portfolios, which used to be not efficient, are now suddenly efficient. So investing more into P than 100% is not that good. It would be better to put your money in one of the portfolios here at the top. This is, of course, not always the case. It depends on what the rate is. But in this example, we see that the one above is actually good. And in fact, this P here is the non-efficient part. Okay. So here, if we go back to the example we had before with different funds and different stocks, now we see that if we assume that we can borrow at a risk-free rate, everything here, investing everything in this mixed fund is actually the best, because we can just leverage up and get a higher return given the risk of any other. So all of these, including that one with very high return, should go away. They're not that good. But realizing that this is probably not true, that we need to borrow at a higher rate. Now this is a very high borrowing rate. Maybe that's one that is if I would like to borrow. Then suddenly this one is not so good anymore. It will still be better than investing in these very poor stocks, but everyone above here are in fact possibly still efficient. But we saw that investing in this stock together with the risk rate was actually better if we had knew in the beginning which one would perform well. So we will get the same picture as before. We have the yellow, the world fund here, which is efficient, and this stock, okay, it's not going to be efficient maybe in the future, but in this example it is. And here also, if we combine that with the risk-free rate, we see that the line is almost as steep. So it was a very big difference for this world fund or the global fund, but not so much different in slope for this stock. And the reason is, of course, that the expected return here and the risk is much, much higher. So the change in the risk rate is not that big. It doesn't have as big impact as if it did here when we don't have so high expected return from the beginning. Okay, and of course, since you want to win the contest in StockTrack, you want to know how can we improve the Sharpe ratio. So to do that, again, we write the formula, which was the expected return, or in your case, the realized return, minus the risk-free rate divided by the risk of your portfolio. Okay. Of course, if you can find stocks which perform very well, so the return go up, that's good for you. But the easiest way, most likely, is to reduce the risk, the standard deviation of the portfolio, and you do that by diversifying. And in this case, we see quite clearly that at least for Swedish funds, it's been a gain investing globally or in global stocks. So possibly you can get a steeper slope, a higher Sharpe ratio, and maybe win the contest if you actually start investing not only in the stocks on the US market, since we're working in the US, but also some in global funds or stocks if you can purchase that. Okay, so that's it for today. Hope it helps. Thank you.